Hey there, investors. Hope you're all doing well and keeping an eye on the markets. Big news out of the Federal Reserve today. It's something that could impact your portfolios and investment strategies. They just announced a quarter-point interest rate cut. Yes, you heard that right, a quarter-point cut. That's right, they're lowering rates again. This is a significant move that could have far-reaching implications. This move brings the benchmark interest rate down by 0.25%. While it might seem small, it's a strategic decision. Now you might be thinking, Jim, why all the fuss over a quarter%? It's a valid question, and here's why it matters. Well, in the world of finance, even small changes like this can have a ripple effect on the whole economy. It's like dropping a pebble into a pond. This rate cut is a big deal because it signals a shift in the Fed's stance on monetary policy. They're adjusting their approach to stimulate the economy. It shows they're concerned about the economy slowing down. They're taking preemptive measures to avoid a potential downturn, and they're taking action to try and keep things humming along. This is their way of ensuring economic stability and growth. Remember, the Fed doesn't make these decisions lightly. Each move is calculated and based on extensive data analysis. They're carefully watching economic indicators like inflation and unemployment. These metrics help them decide the best course of action. So keep an eye on your investments and stay informed. This rate cut could open up new opportunities for growth and profit. Stay tuned for more updates, and as always, happy investing. Now, this latest rate cut isn't happening in a vacuum. It's actually the third consecutive cut the Fed has made. That's right, 3 cuts in a row. This tells us a couple of things. First, the Fed is really committed to supporting economic growth. They're willing to use their tools to keep things moving in the right direction. Second, it suggests they're seeing some signs of weakness in the economy. We've seen some mixed signals from the economy lately. Some sectors are doing great while others are struggling. The Fed is clearly paying attention to these mixed signals, and they're acting to try and prevent a full-blown slowdown. Don't forget, the Fed's actions today will have implications for months to come. One of the biggest factors on the Fed's radar is inflation. This economic phenomenon is a critical indicator of the health of the economy and can influence everything from the cost of groceries to the price of housing. Remember, inflation is a general increase in prices. When inflation rises, the purchasing power of your money decreases, meaning you get less for the same amount of money, and it can eat away at your purchasing power. This is why it's a major concern for both consumers and policymakers alike. The Fed has a target inflation rate of 2%. This target is considered optimal for promoting economic growth while keeping prices stable. That means they want prices to rise by about 2% per year. This level of inflation is seen as a sign of a healthy economy, where demand is strong and businesses are thriving. Why? Because a little bit of inflation is actually a good thing. It encourages people to spend money today rather than save it for later, which helps keep the economy moving. It encourages people to spend money today rather than save it for later. This spending drives economic activity, leading to more jobs and higher wages. But lately, inflation has been running a bit hotter than the Fed would like. This has been due to a variety of factors, including supply chain disruptions and increased consumer demand. That's one of the reasons they've been cutting interest rates. By making borrowing cheaper, they hope to stimulate spending and investment. By lowering rates, the Fed is hoping to encourage more borrowing and spending. This can help businesses expand and create more jobs, further boosting the economy. This can help boost economic activity and keep inflation under control. However, it's a delicate balance to maintain. However, there's always a risk that they could overshoot their target. If inflation rises too quickly, it can lead to economic instability and uncertainty. Too much inflation can be a bad thing, leading to uncertainty and instability. It can erode savings, increase the cost of living, and make it harder for businesses to plan for the future. This is why the Fed's job of managing inflation is so crucial and challenging. So, how exactly does cutting interest rates stimulate the economy? Well, it all comes down to borrowing costs. When the Fed lowers rates, it becomes cheaper for businesses and consumers to borrow money. Think about it like this. If you're a business owner looking to expand, lower interest rates mean you can get a loan at a more affordable rate. This makes it easier for you to invest in your business. Maybe you hire more employees, buy new equipment, or open a new location. All of this activity can help boost the economy. On the consumer side, lower rates mean it's cheaper to take out a mortgage, buy a car, or finance other big purchases.
Now, not everyone agrees with the Fed's decision to cut rates. Some economists argue that the economy is still strong enough to handle higher rates. They worry that by cutting rates too aggressively, the Fed is risking inflation down the road. Others believe that the rate cuts are necessary to prevent a recession. They argue that the global economy is slowing down and that the United States needs to take action to protect itself.
So, who's right? The truth is, no one knows for sure how the economy will react to these rate cuts. Only time will tell whether the Fed made the right call, but one thing is certain. The Fed is closely monitoring the situation, and they're ready to adjust course if necessary. Section 6. Economic bright spots. Despite some of the headwinds facing the economy, there are also some bright spots. Consumer spending, which makes up a huge chunk of the U.S. economy, remains strong. People are still out there shopping, eating at restaurants, and taking vacations. This tells us that consumers are feeling confident about the economy, and they're willing to spend their hard-earned money. Businesses are also continuing to invest in equipment and software. This is a positive sign, as it suggests that businesses are optimistic about the future. They're putting their money where their mouth is, and investing in growth. Section 7. The Fed's dual mandate. Remember, the Federal Reserve has a dual mandate. That means they have two main goals: maximum employment and stable prices. These goals are sometimes referred to as the Fed's North Stars. They guide everything the Fed does. The Fed's latest rate cut is a perfect example of how they try to balance these two goals. By lowering rates, they're hoping to boost economic activity and support job growth. At the same time, they're keeping a close eye on inflation. It's a delicate balancing act. But the Fed has a long history of navigating these challenges. Section 8. A cautious approach to the future. Now, don't expect the Fed to make any sudden moves. They've made it clear that they're taking a cautious approach to future rate adjustments. They want to see how the economy responds to the recent cuts before making any further changes. This means they'll be closely watching economic data. They'll be looking for signs that inflation is under control, the labor market is strong, and economic growth is sustainable. The Fed doesn't want to get too far ahead of themselves. They understand that monetary policy operates with a lag. Changes they make today might not have a full impact on the economy for several months.
Section 9. Global trade, a wildcard. In today's interconnected world, the dynamics of global trade play a crucial role in shaping economic policies and outcomes. The intricate web of trade routes and economic forces can create both opportunities and challenges for nations around the globe. Of course, the Fed doesn't operate in a bubble. The Federal Reserve, while primarily focused on the US economy, must also keep a vigilant eye on international developments. The decisions made by the Fed are influenced by a myriad of global factors that can have far-reaching implications. They have to consider the global economic landscape as well. This means analyzing trends in international markets, understanding the economic health of key trading partners, and anticipating potential disruptions that could arise from geopolitical events. And right now, there's a lot of uncertainty on the global stage. Trade tensions, political instability, and economic slowdowns in various regions are creating a volatile environment. These uncertainties can lead to fluctuations in currency values, shifts in trade balances, and changes in investor sentiment. And slowing growth in other parts of the world are all factors that the Fed has to weigh. The ripple effects of these global issues can impact domestic economic conditions, influencing everything from inflation rates to employment levels. These global factors add another layer of complexity to the Fed's decision-making process. The challenge lies in accurately interpreting the data and making informed predictions about future economic trends. This requires a deep understanding of both domestic and international economic indicators. They make it even more challenging for the Fed to predict how the economy will perform in the coming months and years. The interconnected nature of the global economy means that a crisis in one part of the world can quickly spread, affecting markets and economies elsewhere. But one thing's for sure: the Fed will continue to monitor the situation closely. They employ a team of experts who constantly analyze global trends and provide insights that inform policy decisions. This ongoing vigilance is crucial for maintaining economic stability, and they'll adjust their policy as needed to fulfill their mandate of maximum employment and stable prices. The Fed's dual mandate requires a delicate balance, and their ability to adapt to changing global conditions is key to achieving these goals. That's it for now, investors. Remember, the world of finance is ever evolving, and staying informed is essential for making sound investment decisions. Stay tuned for more updates from the exciting world of finance. We'll continue to bring you the latest insights and analysis to help you navigate the complexities of the global economy.